For the Wall Street Exclusive, I'm Joe Springer, helping you make informed decisions so you can succeed in the market. Okay, we just talked about how to get the big upside with a call option. Now we're going to sell a call option. We're going to talk about an opportunity to sell insurance on stocks. You've always wanted to sell insurance. Okay, the muddled up bond market should continue to drive stocks higher, and at very least, it should put us a floor underneath the stock market because there's really nowhere else to put your money that makes sense. If you sell out of the stock market, where are you going to put your money? The bonds, cash, you lose money. So money can't really flee the stock market too well because it doesn't really have a reasonable place to go. Okay, so because of that, there's an opportunity to sell insurance in something of an advantaged way. If your opinion is that because of the bond market, there's really nowhere for the money in the stock market to go and has to stay in the stock market, but other people might be saying, you know what, the stock market's been rising for 5 years, I'm so scared, I want to buy some insurance. And so there you go. And so you know there's no better alternative to the stock market, so you can make some income selling insurance. So what we're suggesting here is selling short-dated calls on the very liquid SPY. So the S&P 500 Index Fund SPY, SPY, closed at $210.23 today. You could buy the SPY and write a March 20th call with a $211 strike for $1.50. What does that mean? Okay, writing a call just means selling a call, and a call is the right to buy a stock at a certain price, the strike price, by a certain date. So in this case, $211 was the strike price, and the expiration date is March 20th. And then, okay, so and so you got $1.50 to do that. So today, and I should say today, those stocks, that option traded for $1.50. Okay, so this is a real life example. Okay, so then, so you buy the SPY, at $210.23. You sell somebody the right to buy from you at $211 for the next 2 weeks. If the SPY rallies for the next 2 weeks and goes to $215, then that person will exercise that option and buy your stock from you for $211. You should be happy. You sold for 77 cents higher than you just bought, and you got paid $1.50 to be in that situation. So you made more than 1% in 2 weeks. Over the course of a year, that's a good return. A very good return. If the SPY stays under $211, you keep your stock and you keep the fee. You keep the SPY and you keep the $1.50. Okay, in this way, you're allowing someone else to have the upside without the downside for a fee. So it's as if you're selling them insurance on the SPY. They can only lose the premium they paid you, and in that way, you are insuring them. Well, do I really want to give up the upside? Well, if you collected $1.50 24 times, remember this is about 2 weeks out, so you should be able to do this 24 times a year. If you collected $1.50 24 times a year and only broke even on the SPY, if you bought the SPY and it never moved and every 2 weeks you did this, you'd get an 18.5% annual return. Not too bad. Not too bad at all considering what bonds are giving you. If you did it just 5 times, you would have $7.50. Remember from our last segment, that's enough to buy that December 2017 call with a $250 strike from our last segment. And that one we think has a good chance to octuple. So if you could do that, if you did this for 5 times, take it 10 weeks, and everything worked out okay, if the SPY just stayed flat, you wouldn't even need it to perform for you. You could afford to have that perhaps octuple in your bag. Okay, so the persistent unattractiveness of the bond market should continue to give support to the stock market because there's no reasonable place else to put your money. And because the market has rallied for the past few years, many people are fearful and willing to pay what turns out to be significant amounts of money to be insured. If they thought about it, they probably would not really want to pay 20% to insure against a loss. Doesn't make much sense, but hey, if you write a lot of short-dated call options, that's what you're getting. Okay, some notes here. Some notes. This first one is a big one. When you are selling calls, when you are writing calls, you want to sell short-dated options. Very important. If you are indeed going to write options, you want to write short-dated options and buy long-dated options. In our example, if you wrote that 24 times a year, you actually are paid more than double if you wrote one long call option. So you could write a call option and say you have the right to buy this from me for the whole year. But if you keep if you keep renewing it every 2 weeks, you get more than double your money. Because what happens is as options approach their expiration, they get cheaper and cheaper until they expire worthless or expire unused. So they're more valuable the more time they give you. That makes sense. Okay, but they do not lose value in a linear fashion. They lose value slowly at first, and then as they get close to their expiration date, they start losing value very quickly. So, my smart, clever, slick friend, when you write short-dated options, you're selling somebody something that's about to lose value very quickly. Aha, pretty good. And when you buy long-dated options, you're buying something that loses value very slowly. So that's big. If you're gonna write call options, write short-dated call options. If you're gonna buy them, don't buy short-dated unless you can get them for like next to nothing. Buy a long ways out if you can, if that makes sense. Okay, another thing to note here is that this is a great strategy for people, writing call options. This is a great strategy for people that don't watch the market. Writing call options is usually not the very best thing to do in retrospect, but it's never the worst thing to do, and it usually puts you in a good position. So in our first example, when the SPY went to 215, well, you would have just been better off owning the SPY and not writing a call. But you didn't know it was going to go to 215, and you still did well. You ended up in a good situation. That's a pretty typical thing to happen when you write a call. If the market gets killed and you were going to be in the SPY anyway, you're a little better off because your losses were offset by your fee a little bit. Okay, so writing a call option is never the worst option, but it's usually not the very best either. Okay. So if you watch the SPY like a hawk, immediately after doing this, you might say, oh no, I shouldn't have written the call because the SPY is surging. Or you might say, oh no, I shouldn't have even bought the SPY in the first place because now it's getting killed. And so if you're going to watch the stock market, if you're going to watch the SPY really closely every day like a hawk, you're going to drive yourself crazy. So try to do something productive with your 2 weeks, because after 10 sessions, these three are up, these three are down. You don't want to watch, okay? So because it doesn't make any sense to watch. Okay. So, and one other note: why aren't you using the VO? We know you like the VO. Why aren't you using the VO? What's this SPY nonsense? The SPY is much more liquid. Its options are much more liquid. If you can pull this off with the VO, go for it. Okay. For the Wall Street exclusive, I'm Joe Springer, helping you make informed decisions. Coming up next, we'll take a look at the cybersecurity stocks, and then we'll take a look at gold.